Nice to see you again. This is Louis Wong. I'm the director of Phillip Securities Hong Kong and PhillipCapital Management Hong Kong. Well, today I will share with you our strategy, fourth quarter strategy on the Hong Kong market. Admittedly, the Hong Kong market is still in a downtrend. The Hang Seng Index has dropped to close to 17,000 early this month. And since then, there was a slight rebound. Now the Hang Seng Index still trading below 18,000. So today, my main theme will be how to deal with the falling market. And one of the answers seems to be picking a dividend investing strategy to pick the high dividend yield stocks, which are more defensive and resilient. Okay, these are the outlines that I will go through with you today. Okay, wait. Let me move this first. Okay, the external macroeconomics are uncertain and US inflation remains at a relatively high level, leading to current market expectations that US interest rates will remain at the current high level for a longer period. I think the latest most popular used term is higher for longer. High interest rate in the US are affecting both the Chinese stock market and Hong Kong stock market in different aspects, in different directions. First of all, we are worried that this will eventually lead to a slowdown in economic activity in the US, leading to a recession, and which will also filter to other countries. And of course, this is an extreme cases, with a worst case scenario, whether this will trigger global systemic risk. But a mild recession in the US still on the cards. And US Treasury bonds has always been considered by the market to have a risk-free rate. When the risk-free rate is too high, funds will flow into the bond market or the bank deposits or money market funds in the US, for instance. And these funds will stay idle in the banking system instead of flowing into the real economy. Hence, lower economic activity will cause corporate earnings growth to slow down further, and this will pressurize the stock market because of lower earnings growth outlook. The so-called DCF model, discounted cash flow model, will be also affected by the higher risk-free rate. When the risk-free rate rises, companies' valuation will also come under pressure, especially growth stocks such as tech stocks based on the DCF valuation model. When funds continue to flow into US dollar assets because US dollar is yielding higher interest rate and also US dollar appreciation prospect, then the non-US currencies will continue to depreciate. This will have an impact on the valuation of say renminbi denominated assets, including stocks. This is also one of the reasons why the China and Hong Kong market fare quite not so well so far this year. Okay. In November last year, the Chinese and Hong Kong stock markets experienced an epic rise due to changes in the mainland's epidemic prevention policies, the reopening of the economy, and the market's expectation that the economy will normalize as well as see a strong recovery. However, as the economic data released by the mainland in March started since March were weaker than expected. The market was worried about the performance of China's economy, coupled with the negative impact of high US interest rates. The Hong Kong and China market continued to weaken amid external and domestic worries. So year to date, the Hang Seng Index has fallen by close to 12%, double-digit fall. Shanghai Composite Index fared better. Year to date was down close to 1%, but it is hovering between the 3,100 level. The Shenzhen Composite Index lost the 10,000 threshold yesterday, dropped below 10,000 again yesterday. Year to date, it was down 9.4%. The FTSE China A50 Index has fallen by 8.4% year to date. So overall, it's a declining market. In this chart, we notice a very high correlation between the economic performance of China and also the Hang Seng Index. You can see the biggest drop was recorded in the third quarter last year, whereby the Hang Seng Index was down 21.2%. There was during the peak of the lockdown, of the COVID lockdown, that was implemented in many cities in China last year in the third quarter. Then in November last year, the government announced they would reopen the economy. They would put an end to the lockdown measures. So the Hang Seng Index rebounded very strongly in the fourth quarter last year, rising by close to 15%. The rally continued in the first quarter, although the momentum has weakened. Hang Seng Index was up 3.1%, supported by relatively better economic data released in the first 2 months of this year. But starting from March, the market realized that the economic recovery in China was not as strong as expected. So it triggered a sell-off in the Hong Kong market. The Hang Seng Index was down 7.2% in the second quarter. And in the third quarter, the market was still under pressure because economic data for July and August remained weak. So the Hang Seng Index was down 5.8% in the third quarter. But we do believe that fiscal policies introduced after the Politburo meeting in late August will start to have an impact on the broad economy in the fourth quarter. So after 2 declining quarters, we do expect the Hang Seng Index to rebound in the fourth quarter. How strong will the rebound be depends on the economic performance in the fourth quarter. So far, we tend to be more conservative, more cautious. We expect maybe only 3% to 5% rebound in the Hang Seng Index in the fourth quarter from the recent low of around 17,100. Okay, the graph on the right-hand side shows the performance of the Shanghai Composite Index and the Hang Seng Index over the past year. So the orange line represents the Hang Seng Index. During the fourth quarter, you can see that the response of the Hong Kong market to the reopening of China's economy comes in a more you see a much stronger response. It rose much more than the the Shanghai Composite Index. But over the last 6 months, as the macroeconomy starts to weaken, the performance between Hang Seng Index and Shanghai Composite Index starts to be more in line. So now the correlation coefficient between Hang Seng and Shanghai Composite Index was around 75% recently. Okay, China's inflation target is 3% higher than that set by the Federal Reserve in the US, but CPI and PPI have continued to be lower than expected in recent months. You can see the latest September CPI was flat, and in July the CPI recorded a negative growth of around 0.2%. So there's still this deflation risk lingering facing China. PPI has been negative since October last year, but has improved in past 3 months. You can see the drop narrowing. There will be only a very slight increase in inflation or even deflation in the long term, which will change the consumption expectations of citizens and businesses. When consumption becomes conservative, there's no rush to consume now, as there's no inflation, or worse still, if there's deflation, there's a deflation risk. Investors will tend to spend less or spend later. It will further hence it will further affect economic development and form a vicious cycle. Okay, China's official manufacturing PMI has shown some improvement over the last few months. You can see after hitting a recent low of 48.8 in May this year. The manufacturing PMI, the official manufacturing PMI, shows improvement, and in September it rose above the 50 boom bust line again, which is a good sign, showing that the manufacturing industry is improving. Whereas the non-manufacturing PMI shows deterioration since February this year, very much affected by the property market. That's still in distress, but recent months also shows some slight improvement. The non-manufacturing PMI improved to rose to 51.7 from in September, from 51 in August. Okay, and it remains so far above the 50 boom bust line. Okay, industries such as air transportation and catering have maintained higher prosperity, reflecting the mainland return to normalcy after the epidemic, and citizens' demand for travel has increased significantly. This is the lending. China's aggregate financing to the real economy in September was 4.12 trillion yuan, higher than market expectation of 3.7 trillion yuan. In the first 3 quarters of this year, the aggregate financing of the real economy to the real economy was 29.3 trillion yuan, 1.4 trillion more yuan, 1.4 trillion yuan more than the period same period last year. So this is also quite encouraging, as credit data has continued to improve in recent months and is higher than market expectation, reflecting increased demand from citizens or businesses for borrowing for consumption and borrowing to expand business, which will ultimately lead to an expansion of economic activities. So together with the fiscal and monetary policies implemented by the Chinese government starting from late August, we do expect some some degree of rebound in the economy in the fourth quarter this year, and that will lead to a rebound in the Hang Seng Index. But so far we only expect a moderate rebound. The differential between M1 and M2 have shown signs of continuing to expand in recent months, although the gap is slightly narrow, reflecting that the market is relatively pessimistic and conservative. That means more money stays in the banking system instead of in the money circulation. So this reflects investors or consumers are taking a more conservative stance. When funds continue to idle in banks, this will reduce the amount of funds flowing into the real economy, thus affecting economic activities. Okay. Let's look at the so-called 三头马车, the three major key economic data: industrial output, retail sales, as well as fixed asset investment. Among the three key economic data, two are fare better than expected in the first 8 months this year. The industrial output was up 3.9% year to date, higher than expected. Expectation was for 3.8% growth, slightly higher, not substantially higher. And retail sales in the first 8 months was up 7% year on year, also slightly higher than expected for expected 6.8% growth. But fixed asset investment continued to be dragged down by property real estate investment. Fixed asset investment was only up 3.2% year on year. So in the first 8 months, slightly lower than expected 3.3% growth. As I mentioned just now, it's dragged down by real estate development investment, which fell by 8.8% in the first 8 months this year, reflecting that real estate developers still focus on destocking and taking a more conservative approach to real estate development investment. Since the total economic volume of real estate and its upstream and downstream sectors accounts for about a quarter of the overall GDP, the conservative stance of real estate developers will continue to drag down China's GDP. So until the real property market in China shows a clear rebound, the economic growth will remain moderate. Overall, these data still reflect insufficient domestic demand and the need for more policy supports. From the past mainland official media and some important meetings, such as the Politburo meeting held in late August, you can see that the mainland authorities understand that the mainland economy has not rebounded as expected and are introducing more monetary and fiscal policies to prop up the economy and improve market expectations. In terms of monetary policies, the People's Bank of China has cut the so-called RRR, commercial banks reserve requirement ratio, twice this year. So the two cuts this year total 50 basis points, estimated to be releasing about 1 trillion yuan in funds to increase market liquidity, making it easier for consumers or companies to borrow money, thereby stimulating economic activity. On the other hand, the People's Bank of China also cut the loan prime rate, LPR, interest rate twice this year by a total of 20 basis points. Interest rate cuts can reduce borrowing costs and increase the spending power of residents or businesses. thus stimulating economic activity. However, you can see that the 20 basis points cut was not sufficient to was not big enough to stimulate the economy. It was there was limitation on the central bank of China, on China's central bank to cut interest rates, because the already the interest rate difference between China and the US is widening. And if China cuts interest rates too aggressively, this will cause the yuan to depreciate further, and that would not not be in the interest of China. So China's central bank is walking is trying to strike a balance between interest rate cut and stabilizing the yuan. Okay, there will also be time lag for interest rate cuts, as well as other monetary policies to filter down to the economy. The time lag is usually about 2 quarters between the transmission of monetary policy to the actual impact on the real economy. Okay, so we do not expect the economy to improve very substantially in the short term, but we do expect that the main China still has considerable room for our cuts and interest rate cuts, and especially next year, if the Fed is done with raising interest rates, and if the US Federal Reserve starts to cut interest rate in the second half next year, then we think China's central bank will be in a better position to carry out interest rate cuts, and we'll expect more interest rate cuts next year for China. With regard to fiscal policies, China's National Development and Reform Commission recently issued the measures on restoring and expanding consumption, which contains up to 20 measures to stimulate residents' consumption and boost overall economic growth. These 20 measures include measures to promote bulk consumption, such as automobiles, housing, electronic products, and home furnishings, as well as consumption in service industries such as catering, cultural tourism, and health services. Specifically, it includes extending and optimizing vehicle purchase tax exemptions for new energy vehicles, strengthening financial support for automobile consumption, and providing appropriate subsidies for green smart home appliances going to rural areas and replacing old home appliances with new ones. So it seems to be still the old tricks used by China, that is to spur consumption in two main areas, vehicle purchase as well as home appliance consumption. However, it is difficult to quantify the actual effect of these policies for the moment, and the stimulation on the stock market so far is quite limited. Except that new energy cars, EVs, have fared better in the second quarter this year, supported by more clarity in terms of the tax incentive provided for EV car purchase. Okay, the Chinese yuan outlook, we are taking a more conservative outlook on the yuan. As previously mentioned, the yuan has continued to weaken in recent months, mainly due to market expectations that US interest rates will remain at current high levels for a longer period, so-called higher for longer. Interest rate differential factors have strengthened the US dollar. And on the other hand, mainland's macroeconomic environment has been weaker than expected. That also adds pressure on the yuan. For yuan to strengthen, it must fulfill two conditions. One of which is the U.S. experience a severe. I mean, for yuan to strengthen very substantially, you may need to either of these two scenarios to happen. First, U.S. experienced a severe recession, and the economy was in rapid decline, prompting the Fed, the U.S. Federal Reserve, to cut interest rate earlier and by a bigger extent, hence causing the US dollar to devalue and lending support to the yuan. On the other scenario will be China has launched large-scale fiscal policies to stimulate the economy, changing market expectations and attracting large amounts of capital to invest in the Chinese economy. But honestly speaking, this is not easy to happen because now provincial governments are more cash-strapped, unlike a few years ago when most provincial governments in China were cash-rich. They could raise funds by issuing provincial bonds, municipal bonds to invest in infrastructure projects. But now most provincial governments are cash-strapped and may not have the financial capability to launch large-scale fiscal policies to stimulate the economy. Okay. Our fourth Q4 index quarter will depend on whether the US will experience a soft landing and China whether will really, as rumor, launch a trillion yuan level fiscal plan that will strengthen the economy and also help corporate earnings to grow faster in either the fourth quarter or next year. The first scenario is whether there will be a recession in US. The 3-month and 10-year Treasury, US Treasury yield rates began to invert in November last year. The yield inversion in the past had accurately predicted the past 8 recessions, and recessions will occur normally 4 to 6 quarters after the inversion. That is, in May, a US recession, though a mild one, may be occurring in the 4th quarter to the 2nd quarter next year. If a US recession cannot be avoided, will the Hong Kong stock market continue to fall? Well, we need to consider the second scenario. That is, will China counteract? Will China launch a bigger trillion level fiscal plan? But referring to the outbreak of the US subprime mortgage crisis in 2008, the Dow fell repeatedly from October 2007 to 2009, falling 54% from its high. On the contrary, at that time, China launched a 4 trillion fiscal plan in November 2008 to stimulate the economy. The mainland's GDP rose to the highest in August 2009, with an increase of 110% in 2009. So, but in current times, whether China will be able to launch the kind of 4 trillion fiscal plan is doubtful. I think at best is a 1 trillion kind of fiscal plan to be launched, and the timing is still uncertain. So in terms of valuation, the current 1-year average price to earning ratio of the Hang Seng is about 9.9 times. You can see around 18,000 here. It's between around 9.9 times historical PE is equivalent to 17,800. So it is in the mid band of the past 5-year PE band. If the US has a recession and China has yet to introduce a trillion-level fiscal policy, the market is likely to fall further in the fourth quarter. If the valuation falls to 9.3 times, it would be equivalent to 16,700. So our index target for the fourth quarter is if the US sees a recession and China does not introduce any big fiscal policy to stimulate the economy, the Hang Seng may fall below 17,000 to 16,700 to 16,800. Worst case scenario will be falling to below 15,000, as shown by the pale blue line here, which represent 8.3 times PE, historical PE. But this is very distressed. This only happens in very distressed situation. Like for instance, in October last year, in October the year before, when the economy was severely hit by the COVID outbreak. Okay, so. Okay, let's continue. Just now, we are talking about the Q4 index target. We expect support around 16,700 to 16,800, which is equivalent to around 9.3 times historical PE for the Hang Seng Index. But based on the current economic condition, we think any rally would be kept around 18,500 to 18,800, which is equivalent to 10.3 times to 10.5 times historical PE. How to deal with the falling market? The market has been falling consistently, and the reversal, there's no reverse in sight, no reversal in sight. So how can investors respond? We reckon that investors can consider investing in high-dividend stocks for long-term investment. Generally, high-dividend stocks are utility companies, but you can, for Hong Kong's case, utility companies did not fare so well in the last 1 year or two, despite, despite that the utility stocks are more defensive and resilient. I think the reason is the utility companies are only paying 4 to 5% dividend yield. So when US Treasury the yield of US Treasury has risen to around 5%, and fixed deposit bank deposit rates also giving 5%, utility companies are no more attractive as they were in the past. Okay, and buying stocks requires facing more risks, such as corporate operational risk and market risk. So ideally, we should look for stocks with higher dividend yields than the risk-free rate. So we have to search for stocks that pay high dividend at than 5 or 6%. The other consideration is whether the company's business is stable enough. We should assess what factors will affect its revenue and therefore future dividend payments. Third criteria to consider is the company's dividend payout, whether it's trending upward in the long term, and is the expected dividend payout rate higher, whether it will be higher in future than it is now. Okay. Other consideration also include what is the proportion of special dividends in total dividends. Sometimes you can pick stocks having 10% or 20% dividend yield, but that may be distorted by the declaration of special dividends, and special dividends may not be recurrent. They may be one-off. So investors need to analyze if there is special dividend in total dividend, and whether this special dividend account for a large part of the total dividend, and what are the reasons for issuing special dividends. In Hong Kong, companies normally issue special dividends either when they have very good results, unexpectedly good results, or they wish to celebrate their anniversary. But anniversary only happen every, say, 10, 20 years or 50 years, so you may need to wait for a rather long time for another special dividend. The other consideration is the long-term trend of the stock price stable. To avoid earning interest but the stock price keeps dropping. This is Chinese, we know as 占息输价. You earn the dividend, but the stock price, you lost in the stock price drop. A high dividend yield does not mean the stock is worth investing in, because sometimes when the high dividend yield is the result of a declining share price. When the share price continues to fall, it will push up the dividend yield. And finally, a final consideration is some red chip stocks listed in Hong Kong. They are subject to dividend tax. So we need to, when the dividend tax are being withheld, are being paid, the effective yield would be maybe lower. So this one, we also need to check if there's dividend tax to be paid. Only for some red chips. Just now we mentioned utility stock used to be defensive plays, but in recent year, I think investors are more fond of Chinese banking and telecommunication, telco stocks. Okay. Among these two sectors, we are more upbeat on the telco sector, and do have reservation about the banking sector, because if you look at the current dividend yield of the banking stock, Chinese banking stocks, right? For instance, the state-owned banking stocks, they are yielding 8 to 9%. Looks attractive, but actually this is, as I mentioned earlier, the high dividend is partly caused by decline in stock prices that push up the dividend yield. And in addition, investors need to be cautious about real estate, the debt crisis, that issue among the property developers, whether it will cause banks' non-performing loans to rise. Current average non-banks non-NPL ratio is around 1.7% currently, which is decent, which is acceptable. But if you look at average banks' NPL ratio in their lending to property related loans. The NPL ratio is much higher, is about 4%. So we are on the watch whether the overall NPL ratio and also the NPL ratio for property-related loans will continue to rise in future, and that may bring about selling pressure on the share price. I'm not sure if you noticed that the Chinese government has recently increased their holding, their stake in the 4 state-owned banks. This is speculated that the last move was 2015. So this was the first increase in holding in 8 years since 2015. It is analyzed that the NPL ratio may deteriorate going forward. So the Chinese government preemptively do share purchase to support the banking stocks prices in advance. So picking banking stocks, investors need to be aware of the potential deterioration in asset quality, which may cause share price to fall. For telcos, we are more upbeat. First of all, although the current dividend yield is only 6 to 7%, but year to date they outperform in share price. So the because of the rise in share price, the yield is not as high as that of the banking stock. Is partly because the share price outperformed. Although the dividend yield is lower than that of mainland banks, the business is growing steadily, is more resilient, less susceptible to the economic downturn, and also the capex, the 5G capex had peaked. So in the next 2 years, before they start to invest in building their 6G network, capex will remain low. So the telco operators will be in a better position to increase the dividend payout in the next 2 years, in 2023 to 2024, because their capex, their network investment capex has peaked last year, and now they can have more cash to pay out to their shareholders. Okay. We advise the following strategy to build a dividend investment strategy. First, try to pick more stocks for diversification, to diversify investment risk, and to use risk-free rate as a benchmark. So to choose stocks with high dividend yield, much higher than the risk-free rate. For stocks that pay dividend, I mean the dividend yield less than risk-free rate, you may rule out those stocks. Investors will also need to take into consideration company revenue growth. So we set a 5-year compound annual growth rate greater than 5% for picking, screening or filtering out high yield stocks. So this is to screen out companies with stable business growth and reduce the risk of business downturn. In view of the debt issues, debt problems faced by property companies, we have in the past, property developers, property companies also pay quite handsome dividend. But now their ability to pay dividend will be limited by their high gearing. So we advise investors to pick stocks with less than 50% debt to equity ratio, so as to exclude companies with high gearing and reduce also the risk of company insolvency. Okay, among our mandate, high dividend mandate, we base on the above mentioned screening criteria, and we pick 15 largest companies by market capitalization that have paid dividend for 3 consecutive fiscal years. Also, another condition is we look for companies that consistently pay dividends for 3 consecutive fiscal years. Okay, I just take 5 stocks from our high dividend stock portfolio as an example to illustrate after our the screening methodology I mentioned just now. So these 5 stocks are namely CNOOC, 883 ticker, Beijing Auto, Beijing 汽车 1958, China Coal, 中煤能源 1898, Anhui Expressway, stock code 995, and Shougang Fushan Resources, stock code 639. Okay, CNOOC, I think I don't need to introduce much talk about the company. It's China's largest offshore crude oil and natural gas producer and one of the world's largest independent oil and gas exploration and production companies. Its main business is the exploration, development, production, and sales of crude oil and natural gas. Its CAGR, it has achieved a CAGR growth rate of 17.8% between 2017 to 2022, and current expected dividend yield is 9.2%. Another favorable factor is it will be supported by expected higher crude oil prices, supported by the supply cut by OPEC Plus, by Saudi Arabia and Russia, as well as if China's demand recover in the 4th quarter, we may also see higher crude oil prices going forward. Okay. Beijing Auto is a leading passenger vehicle manufacturer in China and is one of the passenger vehicle manufacturers with the most optimized brand layout and business system in the industry. Its brands cover joint venture premium passenger vehicles, joint venture with Mercedes-Benz and Korea's Hyundai. Its major business operations include research and development, manufacturing, sales and after-sale services of passenger vehicles, production of core parts and components of passenger vehicles, car financing, international businesses, and other related businesses. Okay, it has 4 business segments, namely its own Beijing brand, Beijing Benz, Beijing Hyundai, and Fujian Benz. And most of the profits actually come from like BMW, like Brilliance China's JV with BMW, which are the golden goose for the company, laying golden eggs, gold eggs for the company. In the between 2017 to 2022, its CAGR rate is 7.3%. So it qualified. Our rule is at least 5%. Current expected dividend yield 8.2%. Okay, China Coal core businesses includes coal mining, coal chemicals. It also generates power and also manufacture coal mining equipment. It has coal mines in different parts of China, namely in Shanxi, Inner Mongolia, Shanxi, and other regions. The company's main coal business ranks among the top in the country in terms of scale. Its production and development layout is concentrated in the nationally planned energy bases and resource-rich provinces and regions in the central and western regions. It leads the industry in the proportion of high-quality production capacity, coal resource reserves, coal mining, washing, and blending technology, and has outstanding competitive advantages in large-scale coal mines and low cost. Between 2017 to 2022, its CAGR rate is as high as 22.1%, much higher than CNOOC and Beijing Auto. Current expected dividend yield is 7.4%. Anhui Expressway, its principal business includes investment, construction, operation, and management of toll roads within Anhui province in China. The company acquires operating expressway assets through various means, such as investment in construction, acquisition, or cooperative operation. The company also provides toll services for vehicles, collect vehicles tolls according to the charging standard, and maintains, repairs, and carries out safety maintenance for the operating expressways. Toll roads are large-scale transportation infrastructures with long payback cycle. The characteristics are capital intensive. The investment return period is long, and the income, however, is relatively stable. Between 2017 and 2022, it achieved a CAGR rate of 12.7%, and current expected dividend yield is 9.1%. Okay, Shougang Fushan Resources, stock code 639. The company is one of the most sizable integrated coking coal corporations in central Western China. Taking Shanxi province as its major investment base, it is principally engaged in mining coking coal, production and sales of raw and cleaning coking coal. The group has 3 premium operating coking coal mines and 3 coal preparation plants. Between 2017 and 2022, its CAGR growth rate is 18.8%, and current expected dividend yield is 12.8%, double-digit dividend yield. Okay, so these are an illustration of how we use the screening methodology to screen out high dividend stocks for investment. Okay, the 5 examples illustration of how we use this methodology to filter out the high dividend stocks. Okay, this part I'll talk a bit about our ETF, our Hong Kong newly listed ETF, which is managed by PhillipCapital Management Hong Kong. This is a passively managed ETF tracking the selective Hong Kong newly listed equities index, and it is the first ETF that focuses on Hong Kong's IPO market. Through IPO listing, you see companies like Tencent, Alibaba, JD.com, Meituan. They have grown rapidly and enormously after the listing in the US as well as in Hong Kong. So we believe there will always be a second Alibaba, a second Tencent, or a second Meituan, and second JD.com. But it's not easy to spot or to make the right call. So we launched this Hong Kong newly listed equities index ETF with the objective of spotting the next Tencent, the next big new growth company, the next Tencent, next Alibaba. The index has maximum number of constant stocks of 50, so it's well diversified, and each stock is capped at 10% weighting for during rebalancing. The index we follow, because it's an active passively managed index, our rebalancing will follow the index providers rebalancing, which is a quarterly rebalancing. But there is a monthly review for new IPOs to be included, for new companies that are listed that see an IPO listing in the last 1 month to be included into the index and the ETF. Based on historical statistics, this index, this selective Hong Kong newly listed equities index did outperform the Hang Seng Index and Hang Seng Tech Index, because it's not only exposed to new economy stocks, but also to exposed to the old economy, some old economy companies. So this is the index guideline. Okay, I'll skip that. Quarterly rebalances will be done in March, June, September, and December each year. And there's an IPO fast entry mechanism. There's the under the monthly review. The monthly review will include recent IPO that rank in top 50 by highest free flow market capitalization. It will enter the index, and our ETF will track the index and add the new constituents every month. There's a liquidity criteria filtering to ensure there will be no liquidity risk among newly listed equities. For instance, the index will take into consideration share class market capitalization, percentage of free float market capitalization, and average daily value traded, to avoid to include very illiquid newly listed companies. Okay, so this is the relative performance of the ETF represented by the blue line. You can see that for most of the time, it outperforms Hang Seng Tech Index, which is represented by the red line, and also the Hang Seng Index, represented by the green line. So it manages to outperform the Hang Seng Index by quite a big margin. Since listing in November last year, 2835, because of the recent drop in the last 2 months, it's still up. It is still up 1% since its listing, and in the same period, the Hang Seng Index dropped 2%, and the Hang Seng Tech increased 1.8%. But I think the main objective of investing in this ETF is to spot the next Alibaba, next Tencent that will be listed on the Hong Kong market. These are the top 10 holdings of the ETF, which include both new economy companies and old economy companies. Nongfu Spring, Nongfu Sanquan, will be regarded as old economy, same as Yum China, Baisheng Zhongguo. These two account for 20%, close to 20% of the portfolio. Other tech companies included in the ETF include Baidu, Kuaishou, Li Auto, Trip.com, Neo, Xiaopeng. So basically, the three EV manufacturers, they are all they are among the top 10 holdings of the ETF. Okay, in terms of sector diversification, is quite balanced. You can see that consumer discretionary accounts for 34% of total weighting, followed by healthcare 26%, and IT accounting for 11%. Other sectors do not account for more than 10% of the whole index. For instance, materials account for 9%, and real estate also account for 9%. So the exposure is much lower. Okay, our take on ATMJ. Alibaba, you can see the share price in the last 6 months. It's in a sideways pattern, trading between $80 to around 90, not more than $100. So 80, 100. Near-term support is expected at $80. Next support 75 if $80. If it breaches the support of $80, near-term resistance is expected at $87, and next resistance is $90. Okay, so it's a relatively tight trading range seen in the last 1-2 months. June quarter financial highlights: revenue increased 14% year-over-year to 234.15 billion yuan. Adjusted EBITDA increased 32% year-over-year to 45.37 billion yuan. There are improvements across all business segments, and free cash flow was 39 billion yuan as of end of June this year, a year-over-year increase of 76%. The company continued to repurchase to do share buyback. In the second quarter, in the June quarter, they repurchased $3.1 billion worth of ADS in this June quarter. It's undergoing a new organizational and governance structure restructure. Starting from the quarter ended June 30, 2023, Alibaba has implemented a new organizational and governance structure, under which it becomes a holding company of 6 major businesses groups and various other businesses. The 6 business groups are namely Taobao and Tmall Group, which includes Taobao, Tmall, Xianyu, 1688.com, and other businesses. This is related to e-commerce. The second business group is Alibaba International Digital Commerce Group, which includes Lazada, AliExpress, Trendyol, Alibaba.com, and other businesses. The third business group, Local Services Group, which mainly includes the to-home business of Eliaome. This is a competitor of Meituan in food catering and food delivery. And the 2 destination business of Amap. Another business group is Cainiao, Smart Logistic Network Limited, which refers to the logistic business of the group. Then followed by Cloud Intelligence Group, which includes Alibaba Cloud, DingTalk, and other businesses. The 6th business group is Digital Media and Entertainment Group, Dawenyu Zituan, which includes Youku, Youku, Damai, and this is mainly for holding concerts performance, and Alibaba Pictures. Other businesses include SunArt, Freshippo, Alibaba Health, Lingxi Games, InTime, Intelligent Information Platform, which mainly consists of UC Web and Quark businesses, Flicky and other businesses. Okay. Tencent, compared to Alibaba, its share price performs weaker. You can see that it once dropped below $300 early this month to a recent low of 295.4. So we reckon that the share price is likely to drop below $300 again. Near-term support is expected at 295. Next support below that would be 285. Near-term resistance is 315. Next resistance will be 325. Its second quarter financial highlights: revenues increased by 11% year-on-year to 149.2 billion, but quarter-on-quarter just flat. Revenue from value-added services increased by 4% to 74.2 billion yuan, among which international games revenues increased by 19% to 12.7 billion yuan. And revenue from online advertising increased by 34% year-on-year to 25 billion in the second quarter, reflecting robust demand for video accounts advertisement and ongoing improvements in machine learning on its advertising platform, as well as a low base effect from the second quarter of 2022. Revenue from fintech and business services increased by 15% year-on-year to 48.6 billion. Fintech services in revenue achieved double-digit year-on-year growth, supported by expansion in both offline and online commercial payment activities. Whereas business service revenue improved to a low double-digit year-on-year growth rate, driven by fees generated from video accounts, live streaming, e-commerce transactions, and modest growth in cloud services. Cost of revenues increased by 3% to 78.4 billion yuan. As a percentage of revenue, cost of revenues decreased to 53% for the second quarter of 2023 from 57% in the same period last year. So it's a good sign for cost of revenues to come down. That will mean bigger profit for shareholders. Profit attributable to equity holders of the company increased by 41% to 26.2 billion yuan in the second quarter this year. Okay, business outlook. The game licensing is improving. Outlook is improving. Chinese regulators granting a batch of new game licenses signals that Beijing was easing its crackdown on the gaming industry. In the last few months, domestic game license, each month we see the giving out of around 80 to 90 new game licenses. Tencent stresses that it would take advantage of every license it has obtained and focus on the quality of games. We expect stable growth in revenue and faster net profit growth, primarily due to favorable revenue mix, increased revenue contribution, and from prior profit growth businesses, better operating leverage, and lasting benefits from cost control measures. Meituan, share price is quite similar to Tencent, seeing new year low recently. The share price dropping to close to $105. It rebounded to around 115 last Thursday. Now it's trading around 114 and 115. Our near-term support for Meituan is $111. Next support will be 105, below 111. Near-term resistance is 120. and near-term next resistance level is 126. Okay. Second quarter financial highlights: revenue increased by 33.4% to 68 billion yuan. Profit was 4.7 billion yuan compared to a loss of 1.1 billion yuan for the same period last year. Adjusted EBITDA was 7.7 billion yuan, reaching the highest level in the company's history. Its core local commerce segment achieved revenue of 51.2 billion yuan, increased by 39.2%. Operating profit increased by 34.8% to 11.1 billion yuan, with operating margin remained relatively flat at 21.8%. Revenues from the new initiative segment, including Meituan Youshuan, Meituan Select, and Meituan Grocery, increased. Meituan Maicai. The revenue from the new initiative segment increased by 18.4% in the second quarter to 16.8 billion yuan. Operating loss for the segment decreased by 23.5% to 5.2 billion, and operating margin improved essentially to negative 31%. The company achieved operating cash flow of 10.9 billion, and held cash and cash equivalents of 27 billion RMB, and short-term treasury use investment of 93.2 billion as of June 30, 2023. So most of these tech giants, they have very strong operating cash flow as well as cash on hand. Okay. Business outlook: however, economic recovery slows down, especially in consumption, will affect Meituan, and new competitor expected. ByteDance, 字节跳动, Douyin is testing food delivery in China, suggesting it wants a slice of the market, which was worth 66.4 billion in 2022. As competition heats up, Meituan will continue to increase aggressive strategies such as discounts and rebates, which will affect its profit margins. Its revenue is expected to grow by 22% each year over the next 3 years. The look of it looks quite decent. However, the rest of the industry is forecast to expand by 36% per year, which is noticeably more attractive. So its PS, price to sales ratio, may fall to levels more in line with the growth outlook. We still don't recommend buy. We think that the valuation in terms of price to sales is still a bit pricey. Meituan launched the Kita brand meal delivery service in Hong Kong on May 19 this year, as its first stop to expand outside mainland China as growth slows at home. It takes time to prove whether it's the right move. Okay. Last company, JD.com, it is the weakest among the 4 ATMJ. It dropped to close to $100, new low since listing in Hong Kong. We expect near-term support to be around $102. If it drops below $100, the next support level would be $95. Near-term resistance is $110. Next resistance, $120. Second quarter financial highlights: net revenues were $287.9 billion, an increase of 7.6% from the second quarter last year. Net profit surges increased by 3.5%, while net service revenues increased by 30.1%. Net income attributable to company's ordinary shareholders was 6.6 billion yuan, compared to 4.4 billion for the same period last year. As of June 30, 2023, the company's cash and cash equivalents, restricted cash and stock and short-term investment total 243.3 billion yuan compared to 226.2 billion as of December 31st, 2022. Okay, business outlook not too promising as it is facing mounting challenges to its e-commerce business amid competition from Pinduoduo, ByteDance, Douyin, and Tencent-backed Kuaishou. Slumping demand for big-ticket items like electronics and appliances, which make up half of its sales. So it's also a victim of the property market, the debt problem of the property market, which affect its the sales of home appliances on its website. It may be under pressure to launch more subsidy campaign following the launch of 1 billion subsidy. 1 billion following the launch of a 10 billion yuan subsidy campaign in early March to compete against its rivals. As single day Shuangshi is approaching, we expect they will once again cave in to market pressure to offer more subsidy campaign to induce investors to induce consumers to spend. Recently, the weakness in the share price was also caused by rumors so that a businessman with the same surname as the company's chairman, the company's chairman, also the founder of the company, was named Richard Liu Xiansheng. Lately there were rumors that a businessman with the surname Liu had been arrested on suspicion of violation of laws that caused sell-off in the in its share price. And recently, at least 7 brokerage firms, including Morgan Stanley and Citigroup, have either downgraded the stock or lowered price targets in the past week. So the outlook still does not look too promising. Okay, so that ends my presentation today.